Hello, today on session 6, I will talk about bonds and their valuation. On our previous sessions, we said that companies may raise funds through two main sources. One is from shareholders' investment, and the second is borrowing from lenders. So borrowing may be in two forms. One is famous for borrowing from financial institutions, banks and others, and the second one is borrowing through issuing bonds. Today we'll talk about bonds and their valuation. In general, a corporate bond or government bond is borrowing from financial markets or individual investors through issuing an agreement and a legal agreement that company promises to pay back periodic payments and principal amount at the end. So we can say that bond is a legally binding agreement between a borrower and a lender that specifies the face value, coupon rate, coupon payment and maturity date of the bond. It means that as an investor, if we go to a financial institution, buy a bond, we will see indenture, that is instruction of a bond, and it will say us about coupon payments, that's periodic payment of that bond, face value, that's par value, payment schedule, how frequently it will pay out the coupons, it may be semi-annual, annually, monthly and others, and the maturity date, until what date that bond is valid. And the bond has yield to maturity, that is required market interest rate on the bond, that is, in others, we'll talk about this indicator in details. In general, this is how much lender requires on this bond. We shouldn't confuse the coupon rate with the required market interest rate. Coupon rate is periodic payment rate that is calculated based on the face value. In corporate bonds, in general, face value is $1,000 or in the currency. For example, if coupon rate is 6%, it means that periodic payment of that bond is 6% of face value, 1,000, that's $60. In general, bonds have maturity of 30 years, but that's, as I said, it's general that there are some bonds with longer than this date and shorter than that date. For example, there are 100-year coupons issued by Volkswagen, Nestle, Walt Disney and other companies. To evaluate a bond, we find present value of cash flows generated through holding this bond. Our general principle is that value of price of any financial asset is present value of future cash flows. If you buy, as an investor, if you buy a bond, you get coupon payments and the principal, that's face value at the end of the period, at the maturity date. So logic is to find present value or price of this bond. We discount that coupon payment at required rate and face value. So let's look at a sample bond. That company has issued a 10-year bond with an 8% annual coupon. Cash flows from the bond will be paid as follows. Cash flows, that is 8% rate results in $80 coupon payments. That's 8% of face value, 1,000. In year one, as an investor, we get $80. In year two, $80. Until the 10th year, we get $80 per period. Here is per year. And at the end of period, we get face value, 1,000. So value of price of this bond is present value of all these cash flows at required market rate, yield to maturity. And these 80 stream is an annuity. So finding a present value of these annuities plus face value of this present value of this lump sum, 1,000, we get price of this one. Or if we generalize this approach as a formula, this is 80 present value annuity factor plus face value discounted as a lump sum at market rate for time to maturity. Frequency of coupon payments, bond terms, bond agreement dictate the frequency of coupon payments. So everything about bonds is written on bond agreement. Coupon rate is expressed in annual terms. Rate, coupon payments in general, it's annual terms, but if the payment schedule is different than annual, we arrange this payment due to that frequency. For example, in US, in general, corporate bonds are paid in semi-annual periods. We need to divide coupon payment on this rate by 2. Dividing the annual coupon payment by the number of compounding periods per year to arrive at the value of each coupon payment. Dividing the annual required rate of return, yield to maturity, by the number of compounding periods per year to arrive at the desired periodic yield. And multiplying the remaining years of the bond's life by the number of compounding periods per year to arrive at the remaining number of coupon payments. Making these adjustments, we convert these numbers into our formula here. We put these numbers in our formula and find price of bond. Consider a US government bond with a 3 to 8% coupon that expires in December 2020. The par value of the bond is $1,000. Coupon payments are made semi-annually, that is June 30th and December 31st for this particular bond. Since the coupon rate is 3 to 8%, the payment is 31.8675. As I said in our time value of money topic, the best way is to show cash flows on timeline. Here we are on time 0 and the rate is 638, that's coupon, and the period is starting from 1st of January 16 until end of December 20th. That is 5 years. And the required rate is, let's say, that is 6%. So what's the present? And the coupon is paid semi-annually. So what's the price of this bond? Price of this bond is present value of future cash flows. Here, starting from this date, we have 5 years from, as I said, from beginning of 2016 until the end of 2020. So we have 5 years. Since the coupon is paid semi-annually, we have 10 periods. We have 2 semi-annual periods in a year, so we have 10 semi-annual periods in 5 years. 1, 2, blah blah blah, 10 years. And we need to find coupon payments, periodic semi-annual coupon payments. Our rate is 6.3 to 8. So this is, as I said, all rates are expressed in annual terms, annual periods. We need to divide these, convert this into semi-annual periods by dividing these to 2. So we get coupon rate, periodic coupon rate as 31,875. So this is semi-annual coupon rate. So semi-annual coupon payment will be, that's the rate of face value, 1,000. Here we get $31.875, 31.8, I rounded to 8, blah blah blah, $31.8, and at the end we'll get plus $1,000. So finding present value of all these cash flows gives us price of this bond. And the rate is 6%. Again, this is expressed per year. Payments are in semi-annual periods. We divide these by 2, get periodic yield to maturity. Price of this bond is 31.8 divided by 1.03 plus 31.8 divided by 1.03%, blah 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 blah, 31.8 divided by to the power of 10 plus face value at the end. So finding present value of this cash flow to get price of this bond. Here we see until this term, this is annuity. We find present value annuity, and this is lump sum. We put cash flows here, find present value of these cash flows, and get the price of this bond. Again, we shouldn't confuse coupon yield with the yield to maturity market rate. These are different rates. Coupon rate is how much company issuer will pay per period. Yield to maturity market rate is how much investor requires, simply. So these are two different terms. And let's say in our same example, required rate is 5%. That is per year, of course. As you see, market rate was 6.3 to 8. The required rate is 5%. This is less than coupon rate. So what will be the bond price? We discount this rate by 2.5%, half of this percent, and find present value, calculate present value of annuity plus present value of lump sum face value. We get $1,060.17. Price of this bond is $1,060.17 at 5% market rate. As we see, this $1,060 is higher than face value. We call this type of bonds premium bonds. You see, it's higher than face value. These are premium bonds. That is, very simply, investor requires 5%, but the company gives 6.3 to 8%, higher than what investor requires. That's why it's valued at higher than face value. That's why we call it premium bonds. And discount bonds, let's assume vice versa. Required rate is 11%. That's higher than 6.3 to 8. It means that investor requires 11%, but company gives about 6%. So what will happen to bond price? We again have coupon payments plus face value and discount all these cash flows at half of 11%, again because of semi-annual payments. Half of 11%, we get 825.69. You see, it's less than face value. So we call this type of bond discount bonds. When required rate is higher than coupon rate, bond price goes below face value. We call this type of bonds discount bonds. And again, logic is simple. As I said, investor requires higher than coupon rate, and they desire to less than face value. And we can say that bond price and required rate yield to maturity is inversely related. When market rate goes up, bond price will go down. Here we can see what I said graphically. When the yield to maturity, that's required rate, is less than coupon, the bond trades at premium. In our first example, that was 5% market yield, but the bond rate is about 6%. Here, during this term, you see it's higher than 1,000. Bond price is higher than 1,000. When it comes to market rate, coupon rate, when market rate equals to, that's yield to maturity equals to coupon rate, bond sells at face value, 1,000. You can calculate for any coupon payments, any type of bonds, equate coupon rate with the market rate, you will get 1,000. When yield to maturity higher than coupon rate, here at these periods, the bond trades at discount. You see the price goes below 1,000. And again, here you see bond price and yield to maturity is inversely related again, and the graph is like convex. We should talk about some bond concepts. bond prices and market interest rates move in opposite directions, inversely related. When coupon rate equals to market rate, yield to maturity price equals to par value. Again, we sell the bond sales at face value, par value. When coupon rate is higher than yield to maturity, price becomes higher than face value. We call these premium bonds. When coupon rate is less than yield to maturity, price goes below par value, face value. We call this type of bonds discount bonds.